Next, yes, Anantakrishnan of Varanium Capital Advisors joins in to discuss the fundamentals of the market. Hi, Anand. Thanks very much for joining in. Well, it seems as though we're closing in on fresh all-time highs, or at least retesting the all-time highs for the Nifty. In such a situation, how would you position your portfolio?
So, I mean, from our perspective, the way we have structured our portfolio is essentially, there are two parts to the portfolio. The first part being where you have consistency of earnings, where we have earnings growth visibility as well as good ROEs. EBITDA margins are quite stable. Valuations may be tad on the expensive side. So you have the sectors like the consumption sectors, auto, retail, FMCG, consumer discretionary. That comes as part of the first piece of the puzzle. The second piece is really where we are looking at IT and pharma more on the export side, given the rupee depreciation as well as given a turnaround that we are seeing both on technology as well as pharma, which is where we are positioning the portfolio. The third portion where we are still waiting to see green shoots emerge is essentially on the infra space. There are a few select plays that you can look at, but broadly our portfolio is constructed on the first two themes, which is basically consumption, retail, private banks, and the export sector, which is IT and pharma.
Anant, IT is mid-cap IT is mostly?
Yeah, mid-cap IT as well as large cap. So we do like an Infosys and a TCS.
Because, yeah, I mean, exactly that point. Only those are the two companies where growth in 19 is going to be more than 18.
Correct.
I mean, the other large cap all will be actually lower. The rate of growth will be lower in 19 versus 18.
So, I mean, obviously, this is at the point of a turnaround because both these companies have invested specifically in the digital space. We are hoping, you know, the BFSI segment.
But you bought them a few months back, right?
We bought them.
Basically, it's a holding.
It's a holding.
You're not buying now.
No, we're not buying anything new. Yeah. In the mid cap, we have a few names like a Take Solutions, which is a kind of a play both on pharma as well as on life sciences as well as technology. So
you categorize that as IT or a pharma company?
It's a combination. It is a technology company. So they help in the analytics as far as life sciences is concerned. So those are the places that we are looking at.
Okay. Anant, you know, you mentioned earnings season this time, but a lot of the companies are going to see good numbers simply because of the low base impact. So are you waiting it out for this earnings season to see what the sustainability of the recovery would be, probably going into, say, the whole entire first half of FY19? Or are you convinced with this quarter's numbers, or will you be convinced? So
the numbers on a comparative basis, on a year-on-year basis, would look good because they are coming off a GST and a destocking phenomena which happened the previous quarter last year. I mean, as I said, as far as the consumption themes, the retail themes are concerned, they would clock anywhere between 25% to 30%, depending upon the company that you're looking at. On auto ancillaries will clock more than 30%. If you look at technology and pharma, select pharma, you would see clocking anywhere around 20 to 22%. Global cyclicals, which have done extremely well, so the likes of Tata Steel and JSW, should, given the firmness in the price, should do well as far as this quarter is concerned. But given the concerns that we have on trade wars, given what we are seeing from pressures which are building up from macro standpoint, we're not sure whether global cyclicals will stick. And the last piece being the infrastructure play as far as India is concerned. They're the likes of L&T, which are showing some signs of new orders and growth, but many of the other select infra players are not doing well. EPC players barring, who have started to show good numbers.
But many of these consumption stocks are already at fresh highs. They're already highly valued. How much of a good earnings season or recovery is already factored in? Would you recommend incrementally buying these stocks?
So absolutely, you're absolutely correct. There is no scope for a PE expansion. You've had the likes of Bajaj Finance, or the likes of GCPL, which have done extremely well. The issue really is in terms of whether there will be surprises on the downside. Therefore, the PE re-rating will happen. But assuming that they are producing the earnings in the range of 25 to 30%, effectively you will see them grow at the same earnings clip without a PE rating. Because in this part of the market, that's the only piece where you're seeing consistency of earnings, which is very difficult to predict in the other parts, whether you'd be look at the PSU side, the infrastructure side. So if you have to look at a portfolio play, you have to be invested, though, as I mentioned, they may be expensive, but they're still hitting their numbers.
Any thoughts on these NBFCs, the brokers who became pretty large, diversified, like Edelweiss and IIFL and Motilal? They've all come off quite significantly. Motilal the most.
Correct. I mean, Motilal has come off quite a bit, but that's mainly because of issues surrounding their Aspire and home finance business. But I believe that the other parts of the business, both on the broking side, I mean, brokerages are having their best quarter ever, as well as their asset management business is doing extremely well. So this is an opportunity, given the fall that we have seen, which is north of 55-60% from the top. So I think it's an opportunity specifically in Motilal. Edelweiss is obviously a play that has done extremely well.
It's only 20% off the high.
Correct. So
the big one is Motilal.
It's Motilal. So we do like Motilal at this price.
Just a quick point. Take Solutions, which you mentioned earlier. I mean, have you been? Because it's up 50-55% this year.
We've been holding it for more than a year now.
So you're not new incremental buyers of the stock?
So incrementally, we've not bought anything recently.
And how do you value this, something like this? I mean, where does it trade at? What is it? What's the peer comparison here?
So essentially, it's global in nature. I mean, you don't really have a specific India play. So you're looking at a company which is likely to grow north of 20-odd% available to you at around 14 to 15 times multiple. We see huge opportunities in the life sciences space, especially given the analytics that they provide. So that's the and the ROEs have started to improve. If you look at the last 4 quarters, consistently the ROEs have started to improve in their case.
Okay, Anand, before we let you go, there's actually some news on Tata Motors. It's been one of the biggest underperformers of this year. What's your sense? Do you think that now that the trade tariff situation is probably receding a little bit, temporarily at least, it might be a good time to look at Tata Motors?
It has been a great value buy for the last 2.5, 3 years. I mean, if you look at the Tata Motors, from a valuation standpoint, it's always been a story which is compelling. And if you actually look at the Tata Motors DVR, which is trading at a 35% discount, is even more compelling. But we've never seen that bridge between the Tata Motors and Tata Motors DVR converge. And the valuation is more geared towards how sales happen both in the US and China, which is where the bulk of the issues we are facing as far as trade is concerned. So we will still hold off till we start seeing stabilization from that quarter.
Okay, all right, Anand, we're going to leave it on that note. Thanks very much for joining in and talking with us.